In the world of business, not all deals are what they seem. Fortunes rise, empires crumble, all with the stroke of a pen. Mergers, acquisitions, hostile takeovers. Welcome to Mergers She Wrote, where we examine strategies and stories behind the biggest deals in business. Because in M&A, the real risks are the ones you don't take. Welcome to Mergers She Wrote. I'm Paloma Goggins, the owner of Nocturnal Legal and your host. Today, you are going to love my guest. If you listen along through this episode, no doubt that you will 10x your business at the exit or sale of your business. I want to welcome Louise Hipperson. She is the owner of Finance Agency. She's been working with businesses for over 15 years in making reliable and accurate financial systems. Thank you so much for being on today.
No, thank you for having me. I'm excited to have this conversation.
Likewise. So I want to just jump right in. For any business owner that's, kind of thinking about exiting in the near future and in the future at all, what are some key habits and systems that can really help a business build trust with future buyers?
Yeah, so when it comes to trust in your numbers, really the trust comes down to you knowing your numbers. So, and when I say you, it could be yourself, if you have an in-house accountant, CFO, controller, but whoever's going to be answering the questions from the buyer, they need to know what the numbers are saying, because the buyer, so they're going to typically look at the last 3 years of financials. They're looking at it to understand trends, patterns, see if there's consistent growth, margins, and ultimately understand the operations of the business. And so if you don't know how to answer those questions, then it's not going to give the confidence that the buyer is going to know that you know how to operate the business. And so it really comes down to two things. It comes down to the preparation of the data and also the review of the data, because you're not going to know yourself what the numbers are saying unless you know what the data is telling you, and that's it's accurate and reliable for that review. So when it comes down to preparation, it's really consistent data, making sure that transactions are handled in the right way, you're reporting the right way, because the buyer's looking over those last 3 years. So you want it to be very easy for them to align the data, to review it and understand how the business is operating. And then it comes down to the review of yourself reviewing the numbers and understanding, okay, what is happening? Why did it happen? How did it happen? And when they ask their questions, you'll be able to answer them. And that really is the trust of what the numbers are saying, because that's the first point that the buyer is going to be looking at before they delve deeper into that due diligence.
I think there are so many business owners out there that are coming from a place where they don't even have their books organized, let alone if they are organized, understanding the numbers to be able to speak to them credibly.
Yeah.
And so I think this idea about not only should you have them organized, but also understand them yourself, not just your, bookkeeping people understand them as well. So if someone is starting from a place of disorganization, what would be your first recommendation, knowing that, regardless of whether someone was preparing to sell, tomorrow or in 10 years from now, that the financials are such a key piece and that the last 3 years are inevitably the most important?
So in your business, bookkeeping, regardless of whether you're going to sell or not, your finances are going to tell you and lead you the way through your business journey. So having that data is going to be able to tell you which direction you should go to improve, where you should cut costs. And so it does start with having that data, because the buyers, like we said, the buyer's going to ask for the last 3 years, which means that you need to plan for that, because you can't go back in time and fix something that based on how the numbers are showing was reflecting of the operations of the business. So you need to be able to prepare, even if you're not thinking about selling your business. And in fact, there's two things that I actually look at operating for the business, and that is operate or act as if you're going to get audited tomorrow, and act as if you're going to sell your business tomorrow. Even if you know you're not going to get audited tomorrow, and even if you're not even thinking about selling, if you approach your business in those two ways, not only is the health of your data is going to have the integrity to be able to sustain or work for an audit, but also you're going to operate a healthy, profitable business, which will then provide a better valuation for you. So, and it really comes down to that data. So as we said, last 3 years is what the buyer is going to be reviewing, and you need to be planning. Historically, you can't go back and change that. So you want to be able to prepare for the next 3 years. What does that look like? Or how do I improve to make that valuation higher? Because ultimately the buyer isn't testing to see how your bookkeeping skills are or what the system you're using, and you're not trying to prove how great your bookkeeping skills or your bookkeeping management is if you're using a bookkeeper. You're looking to find the best valuation, the most true and fair valuation of your business to get the, for whatever reason you're exiting, maybe you're merging, maybe you're looking to transition to something, there is always a financial motivation. And so the numbers, you want that to be the best financial position that you can to sell. And the buyer's looking to see, okay, how accurate are these numbers to continue operating the business going forward? Is it going to continue making me money in the future? And the numbers are the gateway to proving and supporting what the ongoing operations of the business is. So you've got two elements, but all coming from the same data. So making sure that your data is organized, making sure it's up to date, you're reviewing it regularly so you understand how the business is operating, will then help with getting that organized, ready for when you potentially, or whatever you decide in the future, but in a potential sale, you'll have that data ready for that valuation.
So what I'm hearing, and correct me if I'm wrong, is that if someone's had historically disorganized financials, it's better for them to then just start doing the right thing and do that consistently for the next 3 to 5 years or however many years forward, right? Than to try and go back and clean it up. Am I hearing that correctly?
Yes and no. So I would definitely say have accurate data, make sure that's cleaned up, make sure you're understanding, because let's just say you decide to sell maybe next year, you still need to have that 3-year period. So having those financials. But I would also say your financials isn't just for your business review or a potential buy, they're for taxes as well. So having them up to date every year is needed anyway on an annual basis. So just having that up to date to make sure that you're also paying the right amount of tax. If you don't have organized numbers, you could be paying more if you haven't added all your business deductions in there, or you could be paying less because there's a mixture of different things in there that shouldn't be reported. And if you ever got audited, then that would be flagged as a red flag and potential all the consequence that comes with that. So I think having organized financials should just be a priority task in anyone that's owning a business and operating, because you need that on an annual basis. But if you are in disarray now, let's get caught up. But then that data is going to tell you your starting point to know how to move forward. And I think that's the power with your numbers. The historic is great, but there's nothing you can do to change that. It's about, okay, what can I do with this data to improve the profitability of my business?
Excellent points. And I think too, this idea that, I mean, for some people going back and doing forensic accounting on their own books might be required because they get audited. But if they're not being audited at some point, to what you were saying with the taxes, like you've already usually filed. And so going back and getting those organized is actually probably, not top priority for most businesses, because on a go forward basis, if you start getting organized and just maintaining that practice, then everything from then on can be clean. But to your point, so let's say a business owner is wanting to sell next year. They haven't been doing good practices. They know they can start with this year to clean things up. Would it behoove them to work with someone like you at the finance agency to come in and try and clean up the last 2 years so that they look more uniform across the last 3 years, even though it's not going to change the past tax filings and all of that?
Yeah, and in fact, that's pretty much where the majority of our project work for that comes to, is like we get brought in to help clean up, not necessarily we have clients and then they start to grow and want to sell. But I'd say the majority of our projects is cleaning up the historic because they're getting ready to sell. And so there's obviously a little bit of tidy up, but actually, even if you've filed taxes and it's not really a concern right now, we actually just went through, we engaged with a client this year. They were looking to sell, but they're exactly to your point, their last 3 years wasn't uniform. And so we need to make sure, it doesn't mean that we're being creative with the numbers, it's just making sure that, everything's reported in the right place. They decided to change how they were reporting 2 years ago. And so that first year did look very different to the second and third year. So just making sure we can understand, okay, this is what the P&L is saying, but this is what the adjustments are, just to make it more uniform, definitely will help with the buyer. And it comes back down to that trust of understanding what the business is doing and making that align so easy for them to be able to review that for themselves.
Maybe simplifying this a little bit further, because I know a lot of business owners don't want to bother themselves with getting the lingo down for finances. What's the big difference between cash accrual, and can you switch between the two? Is it kind of a mess when companies decide to switch, or is it something that once you start, you kind of are stuck in that cash versus accrual?
Well, actually, some businesses will use both. So it really depends on how your business is operating and what you're looking at. From a tax perspective, majority of businesses are operating on a cash basis, whereas you might look at profitability in your business on an accrual basis. So just to explain both, cash basis is when you're reporting revenue and expenses on the date it was incurred. So let's just say you send an invoice to a client in January, and the invoice is dated January. On a cash basis, if they paid in February, that revenue is going to be reported in February. But let's just say you actually physically worked in January for that invoice. Well, on an accrual basis, it will be reported in January. So it depends on whether cash is when it physically had the transaction of cash. Accrual is when the date of the transaction was worked. So just to help with in a cost example, let's just say you booked travel today for something in October. Well, if it was on accrual basis, the cost would actually be incurred in or being reported in October, not today when it physically came out of your bank or credit card. So that's the difference. From a tax perspective, you're looking at cash because you don't want to pay taxes on invoices that you haven't been paid for. So you're looking at it from a cash basis. But when you're looking at profitability, you want to see, okay, how much have we actually invoiced out, with the hope that you're going to get paid eventually, but how much have we actually sent out in invoices? How much have we actually incurred in cost? And how does that line up for that period to help you with really truly understanding how profitable you are in your financials? So you need to look at both at different times, but it's all the same data. It's just how and when it's being reported.
I like that explanation. And to tie this kind of back into something that I see frequently in the M&A industry is that, when someone is purchasing a business with a lot of AR, accounts receivable, there's inherently this decision about whether the accounts receivable will be collectible, and sometimes it gets wrapped into that purchase price. And so to your point, having really well organized financials to show historically that, every time you have this like large sum of accounts receivable, that on average you're collecting those, albeit delayed, helps to at least provide comfort to a buyer who's packaging that into the purchase price under the assumption that they will in fact be able to collect those later. And a lot of times when you can't show proof of that, you get buyers that want to have an earnout or some other mechanism where they're holding back a portion of the purchase price under the assumption that you're wrong and you won't be able to collect the AR, or the revenue's not going to be there like it was the past years. So I think it just hits home this idea that you're looking at both sides of the coin when it comes to accrual versus cash, because in some ways people want to be able to see that you're operating with good cash flow, but at the same time, they also want to know my cash flow is going to be there in the future as well.
Yes, and it really comes back down to what we said at the beginning of it's really knowing your numbers, because on the financials that the buyer is seeing, they're seeing top level, and that number can be interpreted any way. So once they start delving in and asking questions, you need to be able to justify and talk to it. Another example of that is inventory, for example. And so you can see like, okay, we've got a potential, if there's like an inventory amount of $1 million once sold, it's like, great, that sounds, it's a great asset to have. But if we then ask the question, well, how long has that inventory been sat there? That completely changes what that number looks like. And so if it's been sat there for 30 days, okay, it means that there's movement in inventory. If it's been sat there for 12 months, what does that look like? How does that impact your valuation? So I think it's also looking at the top level of the number, but then how does that impact going forward in the future? And again, that's what the buyer is testing, is to see how can this business continue operating. So it's making sure your data is accurate, because if that $1 million is also inaccurate in terms of inventory, they could be making decisions based on inaccurate information, making sure you know the numbers. And then that's the only way to know that is to get your data organized and reviewing regularly.
I love what you said, because it is an absolute nugget for a potential buyer, not the sell side, because I have seen situations where the data being reported is inaccurate, arguably false. Whether it's intentionally false is TBD, right? Sometimes I think it's just bad practices, but I've seen people come in and they buy businesses where the inventory is supposed to be saleable, usable, things that they're going to rely on to continue operations. They close, they show up, they figure out that most of the inventory is not saleable, and that essentially they purchase a bunch of inventory that's no good. I think that highlights the importance on the back end from a buyer's perspective to go and inspect your inventory before you buy it, which a lot of people glaze over, or if they're an out-of-state buyer, they don't think it's worth the hassle to fly in pre-closing and do that due diligence, which I would argue it's very important. But to your point, if a seller is not using good practices, whether it's intentional or not, you're in the purchase agreement, there's a representation and warranty by the seller that the inventory is good and saleable, or as is, depending on the situation. Most of the time, a buyer isn't going to allow an as is clause because there's too much risk. And so if they come in and find out it's not saleable, you could have a giant breach of representations and warranties on your hand. So that just ties back into what you were saying, which is that having good data is absolutely the most critical component.
And it can go the other way as well. In fact, we had an engagement this year where we were brought in during the due diligence process. So they had already presented financials to the buyer, and they had questions, and there was a liability account on the balance sheet, and they were questioning it. And so they weren't really sure what it was. They were saying like, well, when they did their own bookkeeping in-house, and they said that when we were doing, playing around in their accounting system, this is what the outcome of those numbers are. So it kind of just threw numbers onto the balance sheet, and they weren't really sure what that meant. But when you reviewed the last 3 years, you saw that liability steadily grow, and it's like, well, why is it growing? So you need to be able to answer to that. But they brought us in to reconcile, and when we reviewed it, it was like, oh, well, there's actually duplicate entries in here. There was so that liability actually was much lower, which then improved the profitability of their P&L, which provides a better valuation overall. However, going back to, does the buyer now have confidence in the numbers versus if they were just accurate but were able to catch that reconciliation error, provide the financials to the buyer in the first place to see, okay, now we've got a much better profit position. So I think it's making sure that, again, it comes down to the integrity of the data, making sure that it's up to date, reliable, and that you understand it. Because if you see a liability growing, that is going to impact the valuation. So they were able to have a better valuation number because it's like, hey, they don't have as much liability in the business. Their profit is actually a lot better. But just that simple reporting error or that discrepancy, because it wasn't caught, there's a lot of back and forth with the buyer that way. So there's going to be questions, there's going to be a lot of back and forth, but I think just making sure that what you present, you're understanding, and then you can catch any reporting issues prior to that as well.
And Louise can say that again, because I feel like most people don't realize in the due diligence phase, there is so much back and forth. And so I think a lot of sellers go into this thinking, I'm going to provide the 3 years of financials, an up-to-date P&L or balance sheet. And, that's going to be the end of it. They'll look at it, they'll figure it out for themselves, and they're always caught off guard when the list of diligence questions related to financials comes back, and it's long and detailed, and sometimes the answers end up causing further drill down into the financials. And so you could say that again times 10. So I want to pivot a little bit here. One of the things that I see a lot with the smaller business owners, which, small in the vast scheme of like the SBA's definition, right? Like not the giant corporations, but people who are lower middle market, small teams, but doing very well financially. I see over and over again these business owners utilizing their bank account as kind of their personal piggy bank side by side with their business. And we all know it's bad practice, but what can a business owner do on the accounting side, bookkeeping side, to make sure that all of the sort of personal expenses that are being drawn out of the account, if they're unwilling and unable to bifurcate and make sure that they're not commingling those types of transactions, because I know you're probably going to say that's the best decision. But what are the options here? And just, run me through, if you were going to advise a small business client who's actively pulling money out on a regular basis for their personal use.
Yeah, so I want to there's two definitions of personal use, especially when it comes to evaluation. So the first thing, absolutely, you want to make sure that your personal and your business expenses are separated and handled separately. So make sure that you have, your business bank account, your business credit card has only business income and expenses coming out. your personal is your personal, and it shouldn't, your personal transactions or your bank and credit card should not even be touching your accounting or your business financials. So making sure that's very separate. And things happen, right? Sometimes you're at the checkout and you're like, oh my gosh, I've only got my business card. You're not going to walk away, go and get your personal card and come back. You're going to use it. But it's also that communication with your bookkeeper, or if you're not doing your bookkeeping yourself, communicating, saying, hey, I charge this onto the business card, but it is a personal expense. Can we handle it? We know where to report it to ensure that it doesn't get included in the business calculations on the P&L. So there's that. It's just making sure it's organized and reported correctly on what's business and personal. But also there are things called owner add backs when it comes to the valuation side of things. So there's some decisions or expenses that you're going to incur that is based on you as the owner deciding to do it. So it's not technically a personal cost, it's a business cost, but it's one that you as the owner has decided to invest in. So should that be part of your valuation on your P&L? Yes or no, and that's what you'll be reviewing. So for example of that is, let's just say you decide to completely rebrand your business. So that is then typically added back to your P&L because that's a one-time expense which you personally as the business owner has decided to invest in, but that doesn't really contribute to the operations of the business. Yes, it might help with the marketing and branding, but really it doesn't impact how the business is operating. So with all these transactions, you just want to make sure that it's being recorded and reported the correct way on whether, okay, is this something that is true personal? We need to make sure that we're taking that out of the business so it's not included in that. And then upon valuation, is all the transactions in there anything that we can add back to improve the profitability and valuation of the business because it was a decision that you as the owner made. So really utilizing, and your accounting systems, I hope you use an accounting system, should be able to help report that separately so you can see consolidated and separate. But really it comes down to making sure you are handling your transactions separately and understanding why they're coming out as well.
I'm glad that you talked about add backs because I feel like one sort of common issue in the smaller business on the end, the lower end of the lower middle market is that inherently you do have a lot of income that's getting pulled out based on the owners being both owner and operator. Mm-hmm. And I think there's a lot of confusion in the unsophisticated buyer that appears in maybe even more of the Main Street space, right? The brick and mortar, the local, coffee shop, for say, as an example, that when you are adding back in all of these costs, there's no like red herring in there that the business is doing poorly and that there's a lie, because I've seen this come up where, buyer sees the financial, sees all these add backs, doesn't understand it, and then gets cold feet and pulls out of the deal. And then we're back to the drawing board and trying to explain sort of what those add backs are and how, if you don't have an owner operator in there, you just have a manager, the financials are going to look drastically different without all the add backs in. So I'm glad you mentioned that because I think there's just so much confusion in that space about how it's not, the add back is not smoke and mirrors.
Yes.
That's the best way to describe it.
Ultimately, the buyer wants to know how is the business operating? And if you're doing a one-time website refresh, that doesn't really contribute to the physical operations of the business. So you just want to, it comes down to judgment, because also to your exact point, if there's a heap of add backs, then it's like, okay, how reliable is the business operating? Or, there's different strategies as well. Valuation of a business is a very different strategy to if you're trying to pay down or reduce your taxes. So one requires more business expenses, what you want to take out as much to show better profitability. So it really depends on the strategy that you're trying to do, which is why it does require planning, looking at your numbers now to see what can you change in the future. Historically, there's nothing you can do about it at that time, but it really comes down to, okay, what am I spending and how am I wanting to report this, but then also tracking that as well. So if you're not even sure if you want to sell in the future, add backs is just something that just out of habit. In fact, we have a client that because they've sold before, it's just now habit that we'll discuss, okay, what could be considered as an add back? And she actually reviews both to understand, okay, what's true operational profitability and then what's profitability from a tax perspective as well. So I think, again, similar to cash and accrual, you need to look at both, you need to understand both, and then make sure that the data is supporting that and tracking that accordingly.
If you will, can you please go into even more simpler, the idea behind wanting to do the add backs differently based on wanting a valuation versus reducing tax liability? Because I think for anybody that's an entrepreneur or a business, small business owner, this also comes into play not just at the exit, but when you're trying to get a loan in your business, when you're trying to buy a home. There's all sorts of kind of peripheral things in your life that could really be drastically changed based on how you're handling these add backs. But please, can you just simplify it a little bit further for anybody who's listening that maybe doesn't quite understand that concept on a broader level?
Yeah, so your financials, it's all the same data, but depending on, I always say that accounting is an art form, right? It's how you interpret it and it's how it's presented. And so it is a math equation, but it's one that moves constantly. And so depending on what strategy you're trying to do will impact how you then operate or what you want the numbers to show. So I say that because, as we said, a tax strategy is going to be very different to a valuation. So taxes, you generally want to pay as little tax as possible, which shows lower profitability. However, and so you're investing, you're spending. However, we actually had a client that said, well, she's self-employed, she wants to get a mortgage, she wants to buy a house. Typically, banks are looking for at least 2 years of self-employment income to help with understanding, what you can borrow. Well, you want to then show as much profit as you can in your business to help provide a better mortgage rate, mortgage amount. And so that strategy changes. And then same with valuation. Again, you're wanting to show as much of a profitable business as possible to get the best valuation that you can. And so these expenses, they're all operating, you all incur them, but it's looking at, okay, but what's true operational cost? And then what's true because I've made the decision as the owner to invest in that. So an example would be, for example, let's just say I decide to invest in a mastermind. That doesn't mean that you don't need to invest in a mastermind to operate your business, but it's something that I wanted to invest in myself. And that can be, pretty pennies sometimes. So when you add that to your financials from a tax perspective, great, that's going to reduce my taxable income. But from a valuation, it's like, well, that's a one-time add back. Let me remove that because that doesn't actually relate to the operations. So from a valuation perspective, the buyer is going to see, okay, I'm seeing true operation profit. Let's add back the cost of because you've deducted the cost. So that's what we're trying to say. We're adding back is that the cost of the mastermind is already in your financials. It's reduced your profit. So we're going to add back the cost of the mastermind to your profit to increase and improve that. So I hope I explained that clearly.
No, I think that was great. And I actually appreciate you using the example of the mastermind because any business owner out there knows that masterminds are always ridiculously priced.
Yeah.
So it's a really good example of a really high expense that could drastically change the financials in terms of looking at them on paper. So.
Yeah. And if I may then also add though, because people will say like, oh, well, that means to reduce my taxes, I need to spend money. Just a note here, but you need to make sure you have the cash to support that investment, because it's not just a case of, okay, I'm just going to spend in order to reduce the reduce the taxable income for taxes. Let's make sure that you're cash healthy as well, which also then contributes to understanding how, from a buyer's perspective, the operations of the business and making sure that you're not just profit healthy, but you're cash and balance sheet healthy as well.
Excellent point. Well, so I know, from your background that you've worked with large corporations as well as entrepreneurs, comparing the two and their practices, obviously every entrepreneur for the most part, and I'm probably generalizing too much here because I know there's plenty of people who like to be solo entrepreneurs in perpetuity, but when someone wants to scale and grow and kind of looks up to those larger corporations as something they want to be someday or some version of that. What is the disparity between the two? What's the difference in how the small guy operates versus the really large corporation? And what could be some advice for people who are having a glow up moment where things are getting complicated really quickly and maybe out of hand from an accounting standpoint?
Yeah, so there's really I have two answers to that. The first one is, to be quite honest, there's not real much difference apart from the numbers, whether there's extra zeros at the end, because the numbers are still going to tell you what your current position is, whether you're operating on 6 figures, 7 figures, 8, 9, the numbers are still going to tell you where you're operating and then how you're managing it. We'll have 7-figure businesses that are making maybe 5% profit, but we might have 6-figure businesses that are making 38% profit. So it really does depend on also you as the business owner. We have those that are willing to spend money and those that are so scared to spend money. And so it's like, okay, it's trying to find that balance between let's save for cash reserves, but still invest in your business. Those decisions, and that's the second answer, is the decisions are also the same, but also it depends on where you are in your business journey. The decisions that you make when you're a solopreneur just starting out, or it's just you, those decisions are very different from when you start bringing on team members. It goes from like, what do I need to do to what do we need to do? And then also I need to manage the team. And they come with a very different set of pros, but also challenges with that. And so the cash reserve number, for example, goes to, okay, can I pay myself? Am I covering all my expenses? Now it goes to, do I have enough money to cover my team and sustain the team in the future? To the next stage of scalability of, okay, are we ready to now open up a different location, a different store, and what does that look like? Do I have the investment, the time, the commitment to do that? So I would say the decisions are all the same. The financials are all the same. You still need to have very strong financial data, make sure it's organized, make sure it's reliable. There's just more volume generally as you start to grow, but the decisions are also based on what stage you are. So no matter whether you're smaller, larger, it's still making sure that you have that financial data integrity and you're reviewing it to then take you to that next level. So I would say working with both, publicly traded businesses and the entrepreneurs, there's different levels of like audit and requirements, but it's all coming down to the same thing. What is the revenue coming in? How am I managing the money coming out? Are we profitable? Are we growing cash? And then what do we invest in the future? Those decisions are all the same.
I think you make an excellent point when it comes to scaling being sort of hinging on that, adding team members, because habitually working with business owners, I'm sure you see the same thing. The biggest hurdle in scaling and growing is not necessarily finding more work or having more revenue. It's bringing on the team to be able to handle that more work and bring in the more revenue, because inevitably as a solopreneur, there's only so many hours in the day. And so this idea of, you had said, when I bring on a team, am I profitable enough to be able to sustain the team? I think is one of the biggest fears that I hear is like, how do I make this leap? In the legal industry, especially in firms like personal injury law firms are a good example, a lot of their sort of finances, from what I understand, I'm generally speaking here because I'm not a personal injury law firm, is that they tend to grow in anticipation of revenue being brought in, which to me is such a terrifying concept that, we're going to take a bridge loan because we're planning on getting this settlement worth $3 million and we can't afford any of our payroll right now, but, give us 6 months and we will. When it comes to like this looking forward at profitability of your business and whether you can afford employees, are there some metrics that you would say you could look at the books and say, this is a better gamble than not? And maybe gamble's the wrong word here, but I mean, at some point you have to take that leap of faith and to know, or at least have faith in your business that it will continue to operate at the same level of revenue or grow even more before you can really start to, I think, grow in a way that's more meaningful and create more profit. But like, I just want to hear your thoughts from like a metrics and a bookkeeping standpoint.
Yeah. So it really, and it comes back down to, as we mentioned, like the business owner, how risky, I guess, and is the word, do they want to invest in their business to make sure that they can, because it's a commitment that you need to cover. So when you bring on someone and you can, whether it's contractor or an employee, when you bring on someone, you want to make sure that you can sustain that commitment long term. And so it comes down to your numbers, like what's your profitability doing? What's your future revenues looking like? And it's really about forecasting and really making sure that you can project, okay, how confident are you in being able to sustain that forecast? Because that's really ultimately what it is. Even if you looked at your numbers today and let's just say you had 50% profit, well, what happens if all those contracts ended next month? can you still sustain that? So your data is going to help you answer that question. But then also I would say really and team is really the biggest questions that we have with all our clients of who do we hire? How much do we hire? What do we hire also? But what do you provide in terms of benefits? All of that has a cost impact. And so understanding, okay, what costs are we going, what's the full commitment? It's not just the $80,000 salary. It is the payroll taxes on top of that, workers' comp. Are you offering benefits? And so when you bake that all in, can you then cover that commitment going forward as well? So again, your data is going to tell you when. And a forecast, I always say, it doesn't tell you no, because a lot of people are like, I don't want to budget. They don't like that word. I don't want to, forecast for anything, but it's because it's confronting, right? It's like, okay, I'm seeing my numbers. What can I do? You typically, the business owner likes to have a more favorable view of what revenue or expenses look like. And then us accountants are like, okay, but based on the historic, what does that look like? You're finding the middle ground to say, when is it the right time to invest? Not, no, you can't invest. It might not be now, but when is the right time based on the decisions that you make to invest in that team member? So I would say it's based on what you are comfortable with, or that's how we've seen with our clients, but the data is going to show when's the right time. And really the right time is, can you cover that salary? Can you cover that cost? And does your profit show that? Because if you added that, what happens to your profit? What happens to your cash? And then do you have the cash to sustain that? So I would say there's no metric. It's more just understanding, okay, if it's this X salary, can my profit cover that?
Excellent points. And I was going to say one thing too that I've seen working with my clients is that it's not only whether they're risk averse or not, right, in deciding to make that investment in building a team and going to the next level, but also, are you willing to take a pay cut yourself? Because a lot of solopreneurs, I think, find themselves in a situation where in order to take the next step forward, they must temporarily take a couple of steps back. And I think that too is frightening in that scalability step, in that they realize, well, as a solopreneur, I'm making X. In order to afford my first employee or my first 2 contractors, I have to essentially take a pay cut. And a lot of times temporarily, if the business is doing well, right? It's just that mindset of like, I'm giving something up and having to have faith in the ability for the business to grow even more now that I have the people. So,
well, it depends on what is important to you, right? So anything that you're investing in your business is at the word I'm thinking is sacrifice to something else. So if you want to free up, you just say you're so busy and you need to bring on an employee and you need to bring on that additional help. Well, what you're doing is replacing your time with someone, which is a cost. So yes, there might be times where you need to reduce your pay. There might be times where you're not paying yourself, especially at the early stages, right? We've all been there. And so it's like, where am I investing this? Am I going to invest in me and then I will be executing the work because it still needs to be delivered? Or am I going to invest in someone who's going to free up my time to be able to go and do the other things that I need to on my business? Really depends on what the priority is. There's no right or wrong. But I do think it's that balancing. Like I said, when you're making decisions, if you do something one way, you're kind of taking away from another. That's what a forecast is telling you, is understanding the financial impact of what your decisions are. So if I invest in X, where can I no longer invest? If I spend money here, I'm reducing my bank account. If I increase my bank account, it means that I'm not investing somewhere that could potentially have return investment. They're the decisions, and that's what that moving math equation is doing with your numbers.
No, it's so true. And I was going to say too, the forecast, right? I mean, inevitably could be more conservative or not. And I think a lot of people lose sight of that as well, is that the forecast is not written in stone. So, the forecast, obviously you want the forecast to be conservative enough that it's close to being true, but it would be nice to outperform it, right?
Yeah.
But you also don't have to look at it as the only reality that you're going to live.
Exactly. It's telling you when is the right time, and then you play with the numbers. It should be something that you review regularly, but to your exact point, it's not set in stone. It's only set in stone once the month closes. So you just want to be able to you're prepared for what those numbers are. Let's just say you forecast you're going to make 100,000 this month, and it came to, you actually closed at 50,000. What impact does that have to your numbers? Do you have enough revenue or cash to cover the expenses in the next month? Because that's all these numbers are doing, is impacting the future. And what does that impact do? So it's to provide you with, okay, what is our current position? And then how do we impact or proactively change what the forecast could be? But yes, it's an evolving document and should be reviewed, but it's not set in stone.
So true. I was just thinking while you were talking about this forecasting and knowing kind of your expenses on a go forward basis, and sitting down recently in my own business and feeling a lot like, and I'm sure most business owners can relate to me, that every piece of software has switched to subscription, and it's starting to feel a lot like our Netflix, YouTube TV, the Amazon. Like, you have now, decentralized cable, and it sounds great in theory, but now you have a channel for everything. And when you add them all together, where most households through just casual conversation, I've learned are paying, double, triple the amount that they were paying for cable plus internet originally when it was bundled together. And I felt that way in my business too, is sitting down and looking at all of my software subscriptions and seeing how decentralized everything has become. And nothing, I remember when Microsoft Office used to buy a disc, right? and you were good to go until the next one came out. And now we're paying monthly for, the Office suite in any capacity. And so I think sitting down and being able to see your forecast, and also the forecast allows you, some of the subscription-based stuff gives you some reliability. It's not great that it's subscription-based, but at least you know what it's going to be on a go-forward basis.
Well, it also helps highlight any changes and variances. So with our forecasting clients, if they said that they were going to spend $1,000 on subscriptions a month, and we see 1 month it's $2,000, that triggers the conversation of like, why? Something happened that we weren't prepared for. Now, most of the time, subscriptions is a great example. In fact, we actually just sent all our clients like the mid-year, do you want your subscriptions list? Just to do a little bit of housekeeping to understand, because more often than not, the clients that did review, they're like, oh, I didn't realize that we had this, this, and this. We're going to cancel this and this and this. You trial things, you test it out to see how it can work in your business, and then something happens, you forget about it. And so I think the forecast is going to help flag what are the things that you weren't expecting. And sometimes it's like, oh, okay, yeah, maybe it's just a timing thing. Insurance paid out, on the 31st of May instead of the 1st of June. So there's those timing things, but that's what these numbers and your forecast with your reviewing of your numbers are going to show, is what are the variances, what's going to trigger to then look deeper so you know your numbers.
I think this is a perfect moment to highlight. I was at a data privacy continuing legal education summit thing, and they had said in the presentation that when the app or the service is free, the product is you. And so I think this highlights a really good reason why having a bookkeeper to be able to send you your list of, hey, here's your recurring fees. She's not selling your data on the back end. And somebody, there's tons of apps. I get ads for them all the time about, download this app and hook it to your bank account, and it will tell you all of these recurring things. It'll help you cancel them. Well, you're not paying for it. And so you're giving away your data for free to these companies that are essentially just monetizing you. And so I think this is a shameless plug for Lou and her team that, she's providing the same type of benefit, but she's also, her and her team are, in your books every day. So not only can they provide you with your recurring subscriptions for an internal audit, and to make sure you actually are buying the things that you want to be buying, but also to kind of help you stay on track, like you said, to make sense of your financials so that when and if you do decide to sell, you can speak intelligently about what the numbers are saying.
Yeah, because especially as you start to grow, typically if it's just you're the one with the credit card, you kind of have a better idea of what you're purchasing. Automation, sometimes get caught up, but otherwise you know what you're spending. When you start adding team members and giving that level of responsibility, that control starts to loosen. I was at an agency where they have 200 employees and they all are, submitting expense claims and whatnot. The owner isn't looking at every single transactions approving, and so it's being able to flag where you can and just keep, have a sense check of what the numbers are, making sure they're understood, making sure that it's in line with what you're planning, having that. And there's also a level of judgment that a lot of apps can't do, of just like, okay, are they go? I haven't used these apps, I won't lie, but so I don't know how the data or information comes to you, but it's like, do they send you every single transaction of just like, is this something that you want to cancel? And it's like, well, I know you can't cancel that because you can't cancel your QuickBooks, otherwise we can't do your bookkeeping. So it's just more like help sense checking the data and making sure that, just from a judgment perspective, is this a cost that makes sense or not? And as bookkeepers, we're not responsible for the activity that you do in your business, but as we're looking at the data and seeing those transactions on an individual basis to report, we get an idea of how your business is operating and be able to flag any, oh, what was this? This insurance payment wasn't meant to happen now. what happened or did something happen? And that's where the conversation comes in, and that's where you then get to know your numbers.
Oh, absolutely. I think this is just another good example of why having bookkeeping can be a critical component of making sure that your business is secure from a spending and data privacy perspective. I had an episode a couple of weeks back with Paige Hansen about data privacy, and we were talking about situations in which employees go rogue, not like intentionally to disrupt things, but like, making purchases on the company card. I've seen it with a client that had a C-level executive that, purchased gift cards and thought it was a directive from the president. And so to your point, having a bookkeeper who is in your books every single month and can see what's normal and what's not normal can flag and potentially save you thousands, if not hundreds of thousands over time, based on potentially fraudulent charges or employees that are doing things that they didn't know was not sanctioned by the company or whatever it may be. So I think that's also, bookkeeping can in a lot of ways help with data privacy, data integrity, and also just financial security of your company.
Absolutely. And I think it's that just relationship that you have with your bookkeeper, making sure you are communicating. Also depends on what level of support you have with them as well. But we do get pulled in when there's something like fraudulent happen, or if they need to get backup for anything, if it's an audit, if there's data that they need to drill down in. We're there to help support and provide that. When you sometimes download a report, let's say from QuickBooks, it can be a bit overwhelming. There's so many columns, you don't know what any of it's saying, but we can just help present it in a way that will make sense to you. Because you didn't start your business to become a bookkeeper or an accountant. You just need to make sure that you know your numbers and have the team, if it's not yourself, to be able to execute it in a way that isn't just about bookkeeping. Like, can you figure out how to use QuickBooks? Yes, but there is accounting principles and compliance that you also are applying to that, which you just want to make sure is correct from the start.
So tell me a little bit about the evolution of the finance agency. I'd love to hear the backstory, and then I'd love to also know, like, as a business owner, what are the ways that the finance agency can come in and help?
Yeah, so just to share, it started off with, so I came into the country now, it's been 10 years, and I knew no one, but the friends that I started making, they were all happened to be entrepreneurs, and being from an accounting background, they would ask me questions and I would answer, and they would say, oh, do you mind just helping my friend? And the next thing I knew, I had clients, and it was a learning curve opportunity for me as well, because I came from a different country. The UK has a very different tax structure to what the US has. And so learning things like sales tax and all the different entities. So it was a journey as an entrepreneur. Even though my background is in accounting, I was going through that entrepreneurial learning with everyone else that I was around with too. I just had, obviously it's just my background, so I just understood the data a little bit better, but it's still something that I had to learn, pick up, and then share with our clients. And then it was just me, and similar to what we were saying, you make decisions for you, and then as you start to add your team, that grows and scales, and now we're able to provide more operational support for our clients to be able to, and really we have a focus on that data integrity. The number of times that, we sometimes will have a client come to us and it's like, okay, we need to clean up the books. And there's a difference with, like I said, bookkeeping is an art form. We all interpret it different ways, but I think, where it's making sure that it makes sense to us, and then we can share that with the client. So really being able to provide that accurate and reliable reporting operationally as well from a billing, AP, bookkeeping perspective is really key, and that's what we continue wanting to do and support other business owners.
Very good. I think anyone listening could tell that Louise came from the UK. I love your accent.
It makes giving information about numbers a lot easier, because it is a confronting subject. So I do find it's a lot easier to deliver, good or bad. Do
you find that people just inherently trust you more? Because I feel like the British accent is, like, for the American mind, at least from my perspective, is that in a lot of cases when it's the proper version, is very eloquent. And so, like, when you're talking about numbers, I'm just like, yes, yeah. All of that makes sense.
Sometimes I do see, I'm like, okay, you're not listening to what I'm actually saying. I can see the eyes glaze a little bit. But I think also it's, like I said, numbers are confronting. It's, no one likes it personally, business. And there is an element of, I joke, like financial therapy. It's the mindset. It's being able to have a conversation with your bookkeeper and accountant. And I think that's the key thing. I'm glad you brought it up. There are so many great CPAs, accountants, bookkeepers, CFOs out there. It really comes down to chemistry. Majority of us know what, numbers, we've either had education, we've had experience, but it comes down to chemistry. And so when finding the right fit for you and your business, it's finding someone that you are comfortable talking to. And even from my side, I might come across as more gentle, but I'm still here to have those tough conversations, and I have the data to back me up with that. So I think it's being able to have the conversation, and then you develop that trust, but you're still responsible for your business to know the numbers. So, we might send reports out. I can't physically force you to look at them, but I think it's more just, it's a partnership, and that's what you're wanting, especially with such an important element of your business.
For the small, solo entrepreneur, is there ever a time that's too early to get bookkeeping on board? Because I feel like bookkeeping, especially when you're starting really lean, I think when you start looking at, even for legal, like I know for a lot of solo entrepreneurs that are on a shoestring trying to get things done and grow on a basis that's difficult, right?
Mm-hmm.
They're trying to support probably themselves, maybe their family, and they're doing it with cash from their savings. Legal can be a cost center for a lot of people. Unfortunately, they find out later that, not having legal involved from the get-go puts you at a disadvantage. Sometimes it causes liability. Is there, obviously probably the sooner the better, but like at what stage do you think it's really imperative that someone bring in a service like yours?
I get asked this a lot. When is the right time to bring in a bookkeeper? And the answer that I generally give first is when you no longer want to do it yourself. If you're not willing to invest the time and commitment to make sure it's done regularly, then you need to outsource this, because it can go wrong, and it can go wrong very quickly. And then there's an impact and a consequence to that. So there's no revenue, if you make 5,000 a month, 50,000, at 50,000, you should bring one. But in those early stages, it's when you no longer want to do it yourself. At the same time, though, similar to we're all business owners, you want to make sure you can cover that financial commitment. So again, if you're investing in bookkeeping, you're probably taking away from something else, and it's understanding what's the priority for you in that time or in that decision. Obviously, if there's not a lot of transactions going through, you should be able to manage it yourself within reason. If it's just trying to figure out how to, there are a lot of resources out there, where even if it's just YouTube or social, just to get the starting points of how to use a system. But you could always reach out to us as well. We're here to answer as many questions as we can to help business owners get the starting point and understanding of the system. Because QuickBooks, for example, is a great system, but I think you need to be an accountant to know how to utilize it properly, and then apply that compliance and that the principles around it. So you can ask the questions, but I think when's the right time is when you're no longer wanting to spend the time to do it.
Well, and I can say, as someone who uses QuickBooks, or at least has logged in to look at QuickBooks, that to me personally, relearning another system wasn't worth the time and energy that I would have otherwise been spending in my business. So I think a lot of this, at what point do you stop DIYing it? There are certain things that I think legal, accounting, compliance, probably data privacy as well. I mean, there's just these little areas of your business that you can DIY it up to a point, and I think that you're probably getting into dangerous territory. I mean, I hear all the time from businesses in the Valley that have been operating for a year or more without any contracts with any of their clients or customers. And my original thought is, how have you gotten this far along without having something in writing other than an invoice? Knowing that inherently there's always disputes or disagreements, or some sort of need to go back to something that's been written and say, well, this is what we agreed to. So I think that this idea of, like you said, if you have the time and energy and you want to learn something like QuickBooks, you can certainly do that off of YouTube. But at some point, is it worth your time and energy?
Yeah, because similar to both legal and accounting, and then I loop in, HR and everything else, the back end of your business, the cost of fixing it is going to cost so much more than you just maintaining it from the get-go. Having that structured contract and having all your ducks in the row to send out to your very first client is going to save you in the long run than a year's time when there is a conversation, if there is a disagreement or an uncertainty around the deliverables or payments. Fixing it is just there's a lot more cost, time, and energy that goes into it than just having that right from the start. And same with bookkeeping. To fix bookkeeping, if, the amount of times where there has been like a tax audit and we have to go back and clean up something, it just costs a lot more to fix than it does to maintain going forward. And also for your own peace of mind as well, making sure okay, this has been looked after. I've had someone review legally, I've had someone review accounting, and just that peace of mind, because that's not what you want to be worrying about in your business.
No, absolutely not. No, I think like going back to what you had said earlier about when is it time to hire, there's like this adage out there, right? And it's like a multiple of like what you're bringing in on an hourly basis. And I can't remember it off the top of my head, but it's something like, if it falls below $75 or $80 an hour and you can hire someone to do that on a contractual basis or even for less, right? That maybe that's better than you spending your time, which could be better spent doing the there's some sort of formula out there, I think, that you could do to determine whether you should outsource or keep it in-house. And I think at some point you get to an area where it will cost you money, but there's time and money trade-offs, right?
Absolutely.
So, well, in closing, like what is one great resource or book or podcast that you've listened to that you think would be great for a business owner, that would, help them in their journey, either on their way to exit or building up their business with the plan at some point in the future to pass on the business to someone or exit?
Yeah, so a book that and oh my gosh, I can't remember the author. So I don't know if I can quickly look it up right now. But it was actually The Art of Persuasion. And I can't remember who the author is now. But The Art of Persuasion, and not, obviously ethically. But I think for me, it's at the end of the day, when you're in your business, you're looking to grow, communicate, and sell. And I think just having the tools to be able to effectively communicate, to be able to effectively know how to position your business is going to ultimately grow your business to a better valuation, to better profit, to be able to invest in more team members, to invest in other things in your business. And so for me, that has been very powerful. Someone who's an accountant who needs structure, process, and kind of that structure and process, it just helped me kind of identify the different elements to consider when you are positioning and speaking about your business. So persuasion is, I think, can sometimes come across as like manipulation, but that's not. It's more just having the tools to be able to know how to position yourself. And I think for me, that was a very recent powerful book that really helped me kind of hone in on that.
Nice. I had another guest who had said how to win friends and influence people, and that probably falls in the same category of being able to persuade or speak in a way that I think, like, to your point, what you said, persuasion at its core is really the ability to talk to someone and have them understand you.
Exactly. And just considering the different elements that come with that. It's not just, I do bookkeeping and accounting services. Even like, yes, from its plainest perspective, but it's just understanding what does that mean for the other person hearing that, and then how can you contribute and continue growing on that discussion or that topic. So that's been helpful for me.
Awesome. Well, thank you so much for being a guest today.
Yeah, thank you. It's been a great conversation.
Thanks for tuning in. Leave a comment below if you have one for us, and look forward to having you listen again to the next episode. In the world of business, not all deals are what they seem. Fortunes rise, empires crumble, all with the stroke of a pen. Mergers, acquisitions, hostile takeovers. Welcome to Mergers She Wrote, where we examine strategies and stories behind the biggest deals in business. Because in M&A, the real risks are the ones you don't take.